Welcome to today's video. What rate of return should I be using for retirement planning? This is really key. We want to get this number right so that we don't have to continue to invest even longer. By the end of this video, you will have the knowledge you need in order to determine the rate of return you should be using for retirement planning. So let's dive right in. All right, I'm going to go over the different factors to consider when you are determining your rate of return for retirement planning. And I'm even going to share the rate that I personally use. Not only that, I'm going to show you a calculator so that you can see the difference in using a lower rate versus a higher rate. All right, the first thing we want to consider when we are determining our rate of return to use during retirement planning is what we are invested in. If we are invested in stocks, that is going to give us a higher return. And if we are invested in bonds, that is going to give us a lower return. So this is really critical when you are determining your rate of return number. A lot of people will just say, oh, use 10% rate of return. But if you're investing all in bonds, there is no way you're going to get a 10% rate of return. So this is a really critical factor to consider when you're determining that rate. And we also want to factor in inflation. I know that recently we have seen really high rates of inflation and other years have been a lot lower. So we want to take this into consideration when we are determining our rate of return for our retirement planning. We also want to consider our time horizon. How long are we going to be investing before we actually retire? Is it going to be 5 years? Is it going to be 30 years? We want to know exactly how long that time horizon is, because that's going to make a difference on our rate of return. If we are investing for a longer amount of time, then we're able to take on more risk and get that higher return. But if it is a short amount of time we are investing, and we decide to be super risky, our investments could drop within that short amount of time, and that would mean our rate of return would also drop. And we also want to be aware of market conditions. If we are investing during a bull market, we are going to see really, really high returns. If we are investing during a bear market, we are going to see lower returns. And this kind of goes along with the time horizon, because if we have that longer time horizon, we're going to be able to go through a bull market and a bear market and another bull market and another bear market and be just fine. But if we have that shorter time horizon, we may only be in the bull market or the bear market. So we want to be aware of that. So now that we know what factors to take into consideration in order to determine our rate of return, what rate of return should we be using? If we are just investing in stocks, then the average return for the stock market has been 10%. But we don't want to just use 10% for our rate of return. We want to take into account inflation. So on average, I know recently it's been a lot higher, but on average, it's a 3% inflation rate. So we can take that 10% and subtract out that 3% and use a 7% return. But we want to make sure that we are investing only in stocks. If we have half in stocks and half in bonds, that 7% return is not going to work for us. And I feel like a lot of people don't realize that because they don't want to be as risky with their investments, but they have to understand that they are not going to get as high of a return on their investments. In order to get that higher rate of return, we need to have that higher risk associated with it. And that's not just to say, oh, be super risky with all of your investments. We can still take calculated risks and still see that high return. For example, if you're putting all of your money into just one company, maybe you're putting all of your money into Amazon, that is going to be super risky. We want to make sure that we have diversification within our investments. Even if we just choose to invest in only stocks, we can do a stock fund, which has a whole bunch of stocks or companies inside of that one single fund. So we're still diversified, but we're still being risky because we are only investing in that stock fund. So we can still expect to see that higher rate of return. And this is what I do. I have the majority of my money in one certain stock fund. And if you want to know which one that is, I have another video. I'll leave a link above. You can check it out later on. And then I have a few different individual stocks, but I don't just have one stock, one company that I have all of my money in. That would be too much risk for me personally. And then going back to using that 7% return, some are worried that may be too high of a rate of return to use, so they want to be more conservative. So they might use a 5 or 6% return. So you have to determine where you feel comfortable, along with taking into account all of those other factors that I mentioned. Because if we say, oh, I'm going to get a 10% return on my money, I only have to invest for 10 years, and then when you get to that 10 years, you did not receive a 10% return, then you'll have to invest for an extra amount of time. I personally use the 7% rate of return, and I have heard of some others using even 10%, because usually over time, when you are progressing in your career, you're getting raises. So you're actually investing more of your money as you go along. And all of these calculators out there allow you to just enter in one certain number or one certain amount you're going to be investing every single month. But honestly, that could increase over time. So a 10% return might feel comfortable to you. Taking a look at bonds and what they have returned, it could be around 4 to 6%, but then we would have to adjust for inflation. So taking off 3% of that. So it's barely above inflation. And I just want to show you the Financial Samurai's blog post about investing a certain percentage in stocks versus bonds. Because if you are going to invest a certain percentage in stocks and bonds, then you can't just use that 7% return or the 3% return. There would need to be a combination. So just make sure that you feel comfortable with whichever rate of return you're going to be using. Because if you are investing a certain percentage in stocks and then a certain percentage in bonds, we want to adjust for that. So we wouldn't want to be using the full 7% return. It would be a little less if we were putting maybe 80% in stocks and 20% in bonds. And of course, it is hard to know the exact number to use because we are looking at historical data, but that doesn't mean that is what is going to happen in the future. For me personally, I feel comfortable using that 7%, but you may not feel comfortable doing that, especially if you're going to be investing a certain percentage in bonds. So come up with the number based on this data that you feel is going to work best for you. And if you want help investing in the stock market and determining the number for your rate of return, I have a free masterclass on how I can help you invest in the stock market and figure out all of these little details like your rate of return for your investments. If you're interested in that, make sure and click the link below and watch the free masterclass. And tell me also, what rate of return are you going to use? And if you found this video helpful, please hit that like button and share it with someone else who would like to hear this information. And to the subscribe button to subscribe to my YouTube channel, and to the little bell to get notified on when I post new videos. And if you want to see even more amazing content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.